Hello, my dear student. I hope you are well wherever you are and you are keeping safe. Welcome for this video tutorial, CPA Section 6, Advanced Public Finance and Taxation. Of course, I'm Faustin Mwinzi, Tax Don. Today, we are going to consider taxation of business income, and in particular, we are going to consider taxation of resident insurance company. And this is a matter that is outlined in the Income Tax Act, Section 19, subsection 3. This is specific to taxation of resident insurance companies' general business. Now, what is provided here under this section, just to remind us, is we tax the premium income less expenses that are attributable to the business. There are two special things that we need to understand concerning insurance from our knowledge in financial reporting and also from tax principles, and specifically what is provided by the Income Tax Act. What you need to realize is the taxable income and the expenses. In there are two things. You need to understand how to compute your premiums and how to compute your claim. The rest that is needed is actually general, and you apply your tax knowledge and your accounting knowledge. When it comes to premium income, this is what is provided in the Act. We tax the gross premium income, less any reinsurance premiums paid. We also less any premiums that are returned to the insured. We less that. You need to understand that especially for purposes of questions that are tested, you'll also have to make adjustment following accrual concept of accounting. You make an adjustment for the premiums that are outstanding at the beginning of the year and premiums outstanding at the end of the year. That is basically what you do to get the net premium income. Then after getting the net premium income, if you follow the Act strictly, then they say other incomes that are attributable to that insurance, and this would be incomes like investment income. You consider them and tax them therein. Then there's one special thing again that you need to do. You need to make an adjustment for an earned premium, or we call it reserve for unexpired risk. Now, that reserve for unexpired risk, we less the reserve that is outstanding at the end of the year, and we add the reserve that is outstanding at the beginning of the year. That's it. Next after that is we have to less expenses, and the expenses that we less, I say there's one important that we need to take care of, is the claims expense. Claims expense, of course, we have to make adjustment for accruals, what is outstanding at the beginning of the year and what is outstanding at the end of the year. Then the next thing that we got to do is make adjustments if there's any amount that is recoverable or claims that are recoverable from the reinsurer. Those ones will have to less. We'll consider an illustration from last sitting, November 2019, and this is going to be question 3. In this question, known as Maisha Mema, we see as follows. You should have the question paper. Maisha Mema Insurance Company. The question gives details of the premiums received, claims paid, commissions ceded, and all these details that are as per the trial balance of this insurance company. Then we have the additional information which talks about the reserves or unexpired risk, the claims that are outstanding. We'll really have to apply our knowledge in the accrual concept of accounting, and in accrual concept of accounting will guide us in making adjustments for these claims that are outstanding at the beginning of the year and claims outstanding at the end of the year. Then same principle will apply on premiums, which are given in note number 3, premiums outstanding at the beginning of the year and premiums outstanding at the end of the year. There are some expenses like what is given note number 3, note number 4, and note number 5, which actually don't relate to this business, or rather they are not allowable. So for these expenses that are not allowable, we'll make an adjustment for them. Then note number 6, of course, is giving us information about interest income, and interest income that is provided here is actually taxable. So this is how we handle a question of this nature. So we come here and write Maisha Mema Insurance Company, income tax computation for the year of income (2019). I'd like to know this fact that we are doing this for the year of income 2019. I'm aware you have information out there that the tax rates have changed, and indeed tax rates have changed. But these tax rates that have changed would actually apply, I know it's 25% and other details that have changed. But we are in the year of income 2019. Remember that. Those rates had not changed in the year 2019. So this is one fact that we need to carry in mind. So we start with computation of the insurance premiums. We need a column over there to record our amounts. Our shillings, we know that are shillings in thousands like this. Right, the first is the gross premium. Which has been given as 30,000. Then on this gross premium, we are going to consider what is in note number 3. We add premiums outstanding carried down. These are the premiums at the end of the year. It is income that has been earned, though it has not yet been received. So for this one, which is actually 12,000, we are actually going to add it over there. Then we are going to less premiums outstanding brought down. That is at the beginning of the year. Brought down at the beginning of the year. And what is provided here is 6,000. So we make this deduction and we derive here at 36,000. The premiums for the year. Then we are going to less premiums returned. These are premiums that have been refunded back to those people that have been insured. We less premiums returned of 5,000. And then we're also going to less reinsurance premiums. Paid. They are paying to their insurers. Remember, in insurance business, from the concept of insurance, an insurance company has to be reinsured. It means that when they receive the insurance income from their clients, they have to pay part of it to the reinsurance company. And that is what we are seeing, that they are paying some reinsurance premiums. And the reinsurance premiums that they are paying amount to 4,000. So we are lessing, and we get down here our net premium income. There's no other adjustment for premiums, so we get our net premium, which is going to be 27,000, our net premium income. After arriving at this net premium income, we are going to now add other incomes. And we go through the question to see whether there are other incomes that are taxable. Now, one of them is commission. On reinsurance ceded. I can explain briefly what we mean by reinsurance commission, or rather commission on reinsurance ceded, is when they give out insurance, they are paid a commission. When they cede part of their business to their reinsurers, then they are paid a commission by their reinsurers, and that is the amount that is provided as 800. The opposite of this is a reinsurance commission accepted, which is actually an allowable expense. Then the next thing we see here as taxable income is foreign exchange gain. Notice that there's use of the word realized. We tax it if it has actually been realized, 3,500. We tax that amount. Then the next one is looking down there, we find that there is dividend from life insurance fund. This has nothing to do with the general business. It is something that is in the life insurance. We have to separate. Now, that is life assurance. We need to leave it out. Then the next one is a rental income. See what the examiner tells us, that this rental income is from commercial premises, because if it was rental income from residential premises, then it would be subject to a different tag that we call MRI. And the examiner was keen that we don't start argument of how we treat this. He made it so specific that this is commercial building. So it is 1,600, but I'd like you to note in the expenses, rather in the additional notes, that we have been guided, rather not in the additional notes, but in this list of rather what is in the trial balance, we have an expense, rental income, we have the gross amount, and then there's repairs to the rental properties of 200. So that expense is deductible. What you are going to do is bring the net amount 1,400 over here. We are just about to close the lists of incomes. Before we do so, we consider this investment income. Investment income is 1.2 million shillings, and when you look at this investment income of 1.2 million shillings, it's given, the breakdown is in note number 6. There's interest from bank of 850 and interest from treasury bonds. Now, let me pick this investment income. There's this treasury bills, or bonds for that matter, or is bonds, but they are all treated the same. This income from treasury bonds, 350, it is gross. So it is gross. But the other one, interest from bank, has been provided as net. Net means what? Net means that this amount has been subjected to withholding tax. We should tax the gross amount, not the net amount. So what we need to do is to gross it up, and to gross it up, we need knowledge of the interest rate that has been applied on this 850. The interest rate on this amount is actually 15%. It means that the net is actually 85%. To gross it up means we get the 100%. So we multiply this one by 100 divided by 85, and this is going to give us 1 million. So at this point, we have to obtain the summation. We have to obtain the summation of the incomes that we have here. Then we make a further adjustment. Let me pick my calculator.